And we are back. The NSE has just closed. Turnover is 492 million shillings for the day. Top traded stock, 11.5 million shares have crossed for Safaricom. The market price was 28.5. A bit of strengthening there and some excitement with regards to the interest from the foreign investors. But today, again, the focus is KCB first half results. We just had an extensive interview, an exclusive one, just hearing what is happening there. I think the thing that stood out for me was the fact that the rate cap decision could come out anytime in October, November, so that not too much of a hurry in that. But before we get into the overview, I know you have actually done an extensive quarter-on-quarter review. What are your thoughts on the numbers?
So the quarter-on-quarter review, the results were very weak.
Okay.
Yeah, so EPS was down 13% quarter-on-quarter. And even on a year-on-year basis, Q2 EPS was down 23%.
Okay.
So for me, I think there are certain things certain Q2 items that contributed to that decline.
All right.
One is that impairment adjustments. Very, very big movements in impairment adjustment. Actually, on a quarter-on-quarter basis, impairment adjustments were up 61%, which was quite of a surprise for me. I think for me, I traced them to two things, and they alluded to this in the event, and you heard them talk about the mobile platform contributing to a surge in NPLs. And also, I think for me, my assessment also, there was a big contribution from Uganda. You know, Uganda, the business in Uganda actually slid into half-year loss.
Yes.
For the other subsidiaries were, well, they're looking okay, but
Uganda specifically. Actually, they've expected South Sudan to be the problem child, but it was Uganda. But actually, Uganda
turned out to be a big problem for them. The second issue that contributed to that decline was also I noticed that the balance sheet funding cost for KCB actually been up. It's not just KCB actually. I've noticed even Equity Bank. I noticed the Stanbic. There's a general increase in balance sheet funding costs. I don't know where it's coming from.
Is that quarter-on-quarter?
It's on a quarter-on-quarter basis,
all right.
And because I
wonder, quarter cost of funds was
cost of funds was actually generally high in Q2.
Do you have a sense
I don't know why. Because the interest rate environment. No, if I look at, for instance, KCB, on a year-on-year basis, the total interest expenses were up 8%.
Okay.
Yes.
Interesting.
And they were up 3% quarter-on-quarter.
Okay.
Q2 was generally a very low interest environment. I don't know where they were picking this expensive. But it's also a function of how KCB funds book. If you look at the presentation they did, still about 30% of their funding actually comes from purchased funds, institutional funds.
So maybe there was an
typically they price you very high. And, and for KCB, I think 30% as a percentage of total funding liabilities, that's very high for KCB. Very high. With the kind of branch network they have, KCB should actually be picking less purchase funds from the market.
Okay. I mean, I like the way you break it onto quarter-on-quarter, and I also like that you've highlighted the fact that provisions, that was the key differentiator. And I think let's just delve on IFRS 9. So IFRS 9 is the one that mandated a review and implementation of reviewed guidelines with regards to provisioning and how you actually look at your books and look at your good loans and your bad loans and provide for them in advance. I think prior to IFRS 9 being implemented this year, the companies or the banks or the financial institutions would just say, this is how our book typically has been, this is how much you have provided. It would be very subjective, so to speak. But then IFRS 9 introduced an objective way of looking at these provisions, saying that you must be able to extrapolate the earnings potential for the bulk of the lending that you have done and look at it on a case-by-case basis. So I think it did trigger a more analytical review of the books, and this explains what has happened here. But then, George, also just alongside the fact that IFRS 9 was implemented, so we are not looking at apples for apples, because this was not in effect in 2018, but it's in effect this year. This was expected. I think my key concern was the cost of risk. So that jumped from 0.8% at the end of the year to about 1.4%. And you're absolutely right. They did say that there was a huge jump related to Fuliza. So they don't actually expect this to be the norm in the second half of the year. So that actually gave me a bit of comfort. Yeah.
But I think I'm still concerned, and you raised an important discussion around IFRS 9. And IFRS 9, as we know it, changes the way banks treat loan impairments. So previously we had the IS, the International Accounting Standards version 39, IS 39, which banks were adjusting for impairments based on a card event.
That line, about all the banks just used to play with that line, just just to make sure that you smoothen your earnings.
Yes, but now we have IFRS 9, which now introduces an expected loss model.
Exactly.
Where it's a very futuristic view on your book, right? But I still have my reservation on IFRS 9 because I don't think IFRS 9 has taken away. You mentioned subjectivity, objectivity. I don't think it has taken away subjectivity. I think
but it must have taken it away to a certain extent. Because for the longest,
I still see subjectivity everywhere.
You have been looking at banks for so long.
Yes.
Honestly, George, used to come first half, it's a very low number, right?
Yeah.
And then it changes in the second half. So you
Yeah.
find second half, the top line, the business is doing well, like, we don't really need to over-provide because we need to smoothen out the bottom line. But with this one, in as much as there's some subjectivity, there is a framework around it.
Yes, it certainly limits it. As you say, it actually limits it. Yeah, but I've seen, I think much of the growth in impairment provisions from KCB and explains the rise in the cost of risk. I think there are some significant write-offs in Q2.
In Q2.
In Q2.
Which then, do you expect them to recur?
I don't expect them to recur.
So
but
second half?
So second half, probably we could have seen the worst of it. But actually, the challenge with KCB is that they're exposed to the sectors that are big recipients of a downturn in the economy. So like, for instance, they have a huge, it's not personal book, but they have a huge check-off book.
Okay, so
Yeah.
that's the personal lending,
This is
which
the
they've
personal
also
lending.
moved it to
And
the
check-off, the
KCB
way it works,
and Pesa and
the way it
Fuliza.
works is check-off is from the salary. So they have
Okay.
an MOU with the employer, and it's deducted upfront.
All right.
The problem with check-off, I think the bulk of the check-off is in the public sector. Now, you know what's happening in the public sector, especially with the county government. They've not been paying salaries for 2 months.
Mm-hmm.
And sometimes in the public sector, sometimes salary is delayed.
So then once that liquidity comes into the market, in a way it does cover that element
So
of
if you
risk.
could see that even the loan origination, the bulk of it was coming from the retail book.
Okay.
So they were big, actually KCB have a big retail book. I think half of the loan book is retail.
Okay, but before we go to the balance sheet, sorry, I tend to be very moving down the income statement.
Yes.
I know we've talked about provisions, but I also noticed that there was a huge improvement on efficiency. The cost to
Yes,
income
that
ratio
was-
was 45.7 and it was 47% last year. I've not done the quarter on quarter, but what stood out for me was actually the growth in fees and commissions. That was up 15% from last year in June up until this year. But then interestingly, on the interest income, the money that they get from extending loans, that was only up 5%. And I think that alludes to the element of your cost of funding,
Yeah.
which certainly went
Yeah,
up.
yeah.
But I mean, I was certainly impressed by the fact that you're operating in an economy that is not doing very well. The appetite for lending is not as much. And we're beginning to see the trend, what Brent King says, Bank 3.0.
Yeah, banks 3.0.
96%.
Where bank is about what you do, not where you go to. But you're right.
George, 96% of the transactions are actually happening outside the bank,
Yes.
which alludes to this cost to income. So it's becoming a leaner and more efficient machine.
But you're right on that. I just don't know what they're going to do with the National Bank.
Very good
Branch
question.
network.
What did you hear about that? What was your sense when you were speaking to people at the briefing?
Yeah, so I think they're very optimistic. I think they'll close this transaction next month, just before the Q3 ends.
Okay.
And I think I see them doing it because obviously Treasury has said, Treasury has basically ignored Parliament's objection to
So
the transaction.
3.8 shillings.
3.8. I think they'll not up the price. They'll not up the price.
You know what I had that was very interesting? So I had one of the investors say, okay, fine. So they have extended an interim dividend for 1 shilling per share.
Yeah.
The CFO did say he doesn't expect any change to the dividend outlook. So that's 3 shillings per share for the full year. So for the interim one, 1 shilling per share, which is being paid in November. So he was saying, you know what, if I'm in National Bank, I am going to go ahead,
Yes, I
take
think
this
it was meant
KCB
to
share.
actually, that interim dividend was meant to
Just to be,
incentivize,
it's sweetening the deal.
sweeten
Sweetening
NBK
the
shareholders
deal.
to come on board.
Exactly.
You come on board like this, 2 months later, I'm going to pay you an interim dividend.
And also, Mr.
of
Joshua
1 shilling
Oigara
share.
did say that they've already gotten commitments from the largest shareholders. That tells me NSSF and not Central Bank, NSSF and the Government of Kenya through
Yeah.
Treasury, they're really on board. And as long as the two are on board, they already get to the 75% mark with regards to success.
Yeah, I think
for
they'll
this.
close the transaction. Maybe they'll close the transaction. But I'm still wondering what's the big picture with the National Bank of Kenya. You're buying a bank that half of its book is not performing.
That's a good
I
question.
think I know it's a liability play for KCB, but I just don't know what do you do with about $250 million worth of non-performing loans.
But you're also getting, in a way, Government of Kenya, so you're increasing your exposure to the government.
My argument has always been that KCB doesn't need National Bank of Kenya to build a
But
strong
it's
public.
getting, George, George, this transaction is going ahead.
Yeah.
So I guess
It's definitely going ahead, yes.
the focus is, I mean, what we've had is maybe a 5% dilution, which is neither here or there. But also what I found interesting with regards to mergers and acquisition is the commentary from the chairman, Mr. Cairo, saying that they're looking at Ethiopia.
Yeah.
They're seeing opportunities in Rwanda.
I think they're more likely going to buy a bank in DRC, if you ask me.
There's DRC and Rwanda.
Yes, because this KCB CEO say that actually over the next 2 years, they want the asset base to hit $10 billion, which is about 10 shillings, 1 trillion shillings.
1 trillion.
In 2 years,
1 trillion
I just don't see that organically growing.
Yes.
I think there are more acquisitions,
so
if you ask me. Yeah, there's a more acquisitions. So KCB could actually do an acquisition in Rwanda, as you say.
Yes.
And more realistically, they could do an acquisition in DRC.
Okay.
Just to keep up with Equity Bank.
Anyway, so we need to wrap this up. I think what we haven't touched on, maybe you can just give a highlight on the balance sheet. I noticed you were saying that the exposure with regard to demand for credit, getting into the personal
the retail business.
Retail business.
Yeah.
And I think I also had manufacturing. Did you hear any other sectors that are actually demanding for this kind of credit?
Yeah, there was manufacturing. I think there was a big actually when I looked at the slide, the personal book actually, the share of personal book actually grew by about 200 basis points, close to 38% of the total book is personal. Okay. So I think...
And it's not Fuliza and KCB and
yes,
Pesa.
I think we are likely to see KCB doing a lot of innovations on how to deliver personal loans. Okay. And I think increasingly...
Do you have Fuliza on your phone?
Yeah, I have Fuliza here. It's one of the most wonderful products I can say. Okay. But I think we're likely to see KCB extending more personal loans through the mobile phone. Okay. Yeah. So George, what I hear you saying is weak Q-on-Q numbers, looking out to see how this is corrected in the second half of the year. You're always saying you're going to short banks. Do you still think there's value for KCB at the current price? Yeah, at the current price, yes, I could say it's fairly valued. Yes. But I'm not going to buy it at, I think KCB now is just about trading at one time at par. It's at par with the book value. Par. So it's okay. It's at par. It's okay. So I'm not going to buy KCB at above one. So you're looking out for triggers. Okay. Thank you so much. I mean, that's all that we have for you today. But our takeout was this: looks like the economy is beginning to demand for credit, especially from the manufacturing sector. If you are an investor, expect maybe 3 shillings per share in terms of dividend and 10 to 11% growth on profit after tax. A bit of weakness on the second quarter. We expect this to correct in the second half of the year. As always, I am certainly a buyer of KCB and I like the stock, I like the story. And if you're a foreign investor, maybe currency would be your potential risk. CBK is doing a fantastic job to manage this and they have the ammunition. So it's certainly something worth to look out for, with the triggers being the rate cap conversation in October and November. Thank you for joining us. We will be live again tomorrow at 2:30, streaming on YouTube Metropole channel. Have a good afternoon.